Well, I feel less Louis Taylor and more Taylor Swift with the microphone.
Well,
Similarity ends there, right?
I'm just hoping I don't say Louis Walsh, so you can keep an eye on me. Welcome, everybody. I am Rachel. I should say that I have done a few things since I did the Khalifa report. I haven't been sitting at home doing nothing. But welcome, Louis, as we've heard, CEO of the British Business Bank. Now, it would be churlish of me to share with the audience that the last time we met was on opposing sides of a rugby match. But I'm delighted to say that the performance of your team on that occasion is not, the poor performance of your team on that occasion is not replicated by your amazing team today. I mean, we're here to talk about capital markets, and it seems to me that all roads point to BBB. You can scarcely be in one of these talks without hearing that mentioned. So as I say, all roads point to you. But it seems to me BBB's mission to drive growth by increasing access to finance for SME businesses, and the Mansion House Compact that we're here to talk about today, the objective of that is indeed to release capital to invest in those things, so potentially a marriage made in heaven. We'll come on to look at that in a moment, but can I just say 10 years of Innovate Finance, how did that happen? 10 years of the British Business Bank, and that means 10 years of your annual report into SME finance. So before we go into the compact, can you just tell us a little bit about what are the trends, looking backwards over the last 10 years, what are the trends, and then perhaps coming forward to where you see us going from here?
Great. Thank you very much indeed for that, Rachel, and thanks to Innovate Finance for inviting me along, and congratulations on your decade as well. So in terms of, Mike's just playing up a little bit, there we go, it's okay. In terms of this report that we put out, as you say, 10th version of the report, I think it's fine, which obviously talked about 2023 as a year, but also had that 10-year perspective on how the landscape for finance for small businesses has changed in the UK. I think the headlines for the last year were that although gross bank lending was down, there was an increase, a corresponding increase pretty much in asset-backed finance, probably explained by the fact that security over in asset-backed finance is on the asset rather than a general charge that maybe a banking facility would cause. Equity was down significantly relative to 2021-22, but to the same level as 2020, which feels, given the economic circumstances, pretty good. Clear disparity in the provision of equity across the UK, heavily skewed to the Golden Triangle, but debt provision actually pretty much proportionate to where GDP is generated. And then the entree into the 10-year view is that fully 59% of bank lending to SMEs was not from the big five. It was from a range of challenger banks, alternative finance providers, and specialist banks who've grown up over the last 10 years, a lot of them tech-enabled. And in the last 10 years, 60 new banking licenses have been issued, 36 to banks that are focused on SME lending. So the diversity of sources of finance for SMEs is massively improved. And I think Alistair talking about people being able to get the money they need to start up, I think we'd agree with. I'm perhaps a little less pessimistic than he is about scale-up, although we've certainly got a lot to do. And I think what the report says is we're coming from a really, really good place, but actually we have the opportunity to do so much better than we do at the moment. So great, but could do better.
Absolutely, and it sounds like you will. It strikes me as very interesting that people in this room, and indeed more broadly here, are not just users of finance, but indeed now some of the main providers of that finance, which is great. Who would have thought that 10 years ago?
You know, that landscape of... sorry about the mics. Here we go. Well, that landscape of finance, I mean, credit to all the entrepreneurial capital that's gone behind it. I mean, the bank has been supportive in terms of helping those banks to get liquidity on relatively unproven business models, but there have been a lot of investors who put a lot of equity behind these banks, and it's been really great to see.
So, on to the Mansion House Compact. 50 billion, I think that's the plan, to unleash 50 billion to make available for some of our great investee companies. And as I think you and I have discussed before, one thing we are not lacking is potential investment opportunities. So 50 billion, but why? What's the problem that the Mansion House Compact is trying to solve?
So I think the problem is that over the last 20 years, we've seen a kind of de-equitization or an evacuation from the UK equity markets of a lot of institutional money that had been investing quite heavily in those markets. What that means is that our growth companies are not getting support from UK investors, with the consequence that when they get support from overseas investors, quite often from the US, they tend to migrate to where their capital came from. And just at the point these companies are becoming really commercially interesting and economically impactful, they're migrating to a different economy. And so the thesis goes that if it's UK institutions that are investing in those companies, we stand a chance of retaining those companies here in the UK. And we're a fantastic innovation ecosystem. We've got great R&D coming out of our universities and from other companies as well. We can get things started, we can do product market match, but then when it comes to really commercializing and scaling up, that's where we really need to provide some more money. So the Mansion House reforms are intended to get more UK institutional money, most particularly DC pension money, defined contribution pension money, investing in the growth economy, rather than perhaps investing, well, the crude characterization would be in government bonds, but they do have a range of different assets. And that £50 billion you talked about, Rachel, not just into venture capital and growth equity, but in other illiquid assets that can create good returns for pensioners, such as infrastructure, real estate, private equity as well.
So pension funds are the answer to some of those issues?
Well, look, it's really interesting. I mean, I worked at Standard Chartered Bank, an emerging markets bank, for a long time, and those emerging markets that really do take off are the ones where you have the formation of pools in size of long-term capital that can invest in productive economic activity. And what we have is a huge pool of capital, which is long-term in nature, but it's not really investing in the productive growth economy that we need in order to secure a prosperous future.
So can I just take a little bit of a step to the right? We've been talking about the Mansion House Compact, which is pension money, DC money in particular, as we've just discussed. A subject very close to my heart is actually proposed retail investment. Do you think that's part of the liquidity solution?
Well, I think it's really important that retail investors are able to take part in a range of assets. They can do that through fund managers, through their pension schemes, and default pension plans quite often have some element of illiquid in there, but I think the Mansion House reforms are intended to increase that. So in Australia, for example, their pension scheme, which has been one of the most successful in the world, has 20% in illiquids, and that's a much smaller proportion in the UK. In the US, 65% of venture capital comes from pension money. In the UK, it's 10%. So there are some big disparities there that we really could look at. For retail investors, I think that they do need some element of protection. There are some things that are probably better for consenting adults and to have some restrictions around them. Illiquidity is something that makes it difficult for retail investors, but we shouldn't underestimate the retail investor. And in terms of a pool of liquidity, potential to be meaningful, I would not say really transformational.
But so potentially useful not just for businesses, but on the demand side, so to speak, actually good for savers. So it's not just give us the money to help our businesses, but it's give us the money to help savers in the UK, whether through their pensions or individually.
Absolutely.
And can you just tell us, what does this money, imagine we've got the 50 billion. What does this mean for SME businesses?
So as I said, I don't think the full 50 billion goes straight into SME businesses, at least not without causing valuations to spike and returns to plummet. So this has got to be an iterative process. It's been a 25-year de-equitization process. It's going to be not dissimilar in terms of longevity to re-equitize as well. Otherwise, we end up with spikes and troughs, which I don't think anybody wants. But for SMEs, what we hope it'll mean is that there is a larger pool of domestic capital able to help companies to scale up. It gives them a greater incentive to be here, and ideally we do want some valuation pickup relative to US markets. If you look at the valuation multiple differential on public markets, even private markets between the US and Europe generally, but including the UK, I would argue that that valuation multiple differential is a barometer of, one, risk appetite, and two, optimism bias. And I think we have a cultural issue here as well as some regulatory issues that are preventing this money going into growth opportunities.
But Mr. Taylor, it's an urgent problem and we are impatient. So all of that being said, what role has the government asked the British Business Bank? I mentioned earlier that it seems that every idea points to you. So what's your role in this?
Mention's been made of the Chancellor at the Mansion House last year and at the autumn statement. And there he asked us to explore creating a vehicle to allow pension funds to invest in venture capital, growth equity, alongside the bank's own commercial programs where we do that. And there are a range of difficulties for institutions to get into this market. They've got to due diligence a lot of companies to find one that they want to invest in. They can only write a smallish check individually for each company because they're early stage companies, and they can't really get broad diversification very rapidly, which is a big risk mitigant to the risk of early stage companies. So the bank over the last 5 years, through particularly its subsidiary British Patient Capital, has built up a position of 70 fund investments in venture and growth equity, with the biggest UK LP in UK venture. And that portfolio of fund investments, the companies they invested in, now need more money. And that offers us the opportunity to harvest a range of co-invest and direct investment opportunities. And so you get a great filtering from a very sort of broad-based fund of funds kind of approach to those companies that really are going to take off and give investors real alpha. So whilst we're not regulated yet, I'm not making anybody an offer. I'll make a big disclaimer, particularly to you, Rachel, as a partner in a law firm. What we're trying to help create is a vehicle for investors to be able to come into alongside the bank in that range of opportunities.
So, Louis.
And it's UK investors helping to invest in UK companies with the intention that they stay in the UK longer, that the employment benefits and the spin-out benefits and the tech benefits and all of those good things remain in the UK economy.
While it's just us and no one else is listening, are you able to tell us anything else about this vehicle? What's it going to look like? When's it coming?
Well, I reiterate the disclaimer I just gave, but I think you'll see that it'll be much more active within the next 12 months. We need to get it regulated because we're managing third-party money. I think it's really important for pension fund trustees to see we're not just creating something from the government and there's an assumption because it's government it should be fine. We should go through the same process that any other investment manager should have to go through, and we should operate at least the same standards of governance and assurance and probity and all the rest that involves. But I think what we're really selling is the track record of the bank in this space and the opportunity that these fund investments provide in the subsequent co-investment opportunities and that real opportunity to participate in the growth companies coming out of the UK. And of course, you know, as an innovative economy, the UK is second to very, very few. And so if you're keen to invest in venture and growth equity, which is the reason for doing that would be to get into technologies ahead of when the market really values them properly, then the UK is a market you should overweight, is the theory.
So did I hear
which I'm not giving an opinion on. Well, it kind of depends on quite a lot of things, but certainly by 2025.
Those pesky regulators, probably. That's very helpful. Can we just take a slightly different turn now to perhaps something that's slightly more embedded, maybe a lot more embedded, and that's your LIFT program. Can you tell us a little bit about that?
Yeah, LIFTS, standing for Long-Term Investment for Technology and Science. So the Chancellor not only asked us to create a vehicle that's going to invest alongside our own sort of government-sponsored programs, but the second prong he asked us to get involved in was to help set up some private sector vehicles that are going to be focused on similar types of companies, that is growth companies led by technology and science. And he allowed us to invest potentially £250 million in setting up 1, 2 or more of those. We did a tender last summer from got a lot of proposals, but we've announced that we are in final negotiations with 2 parties, with Schroders and with ICG, to set up 2 private sector vehicles. The future is, I think, multiple private sector vehicles, and in fact, this government-sponsored vehicle in the bank, we hope that in 10 years' time, it will have catalyzed enough money into the market and enough imitators and competitors that, frankly, we can stand back. So that two-pronged approach. The other thing to say about lifts, really, really important, is that both of the vehicles we're working with Schroders and ICG on have got match money compared to ours from Phoenix, which is a DC pension provider. So there is DC pension money going into growth and venture equity.
Thank you. You're very good at this. So we've got investee companies and indeed providers of funding in the room, and hopefully lots of money coming through. So I hope you will see that all roads, as I said, point to Louis and the BBB generally. We owe them a huge debt of gratitude, and I hope you're eating your shredded wheat for breakfast. Can you join me in thanking Louis? Thank you.
Thank you. Thank you.